Ryan Solis bought a brand new $800,000 production facility. The equipment was state-of-the-art. The location was perfect. His investors were impressed. 18 months later, he shut it down. Not because it failed to produce, not because customers stopped buying. He shut it down because it was working perfectly and still destroying his business. Watch till the end. There's one rule buried in this story that every investor and business owner should know before they spend a single dollar. Almost nobody talks about it. Ryan ran a mid-sized custom packaging company in Denver, Colorado. 12 years in the business, solid reputation, loyal clients in retail, food, and pharmaceuticals. When a major grocery chain offered him a long-term supply contract, Ryan saw his moment. To fulfill it, he needed to scale, fast. He pitched to 3 investors, raised $800,000, and built out a dedicated production facility just outside the city. Everyone around him called it the right move. The facility launched on schedule. Production hummed. The grocery chain was happy. Revenue jumped from $1.1 million to $1.9 million in the first year. Ryan posted the numbers to his investor group. Champagne emoji, handshake emoji, the whole thing. But one investor, a quiet, older man named Frank, who'd spent 30 years in private equity, didn't respond. A week later, Frank requested a call. "Ryan, walk me through your cost of capital." Ryan paused. "Sorry? The $800,000 we gave you. What rate of return does the business need to generate, just to justify that investment?" Ryan pulled up his numbers. Investors expected 14% annual return, standard for the risk level. That meant the facility needed to generate at least $112,000 in profit per year, just to cover what the capital costs to raise. Ryan went quiet. The facility had increased revenue by $800,000, but after operating costs, staff, equipment depreciation, and loan servicing, the facility's net contribution was $74,000. He stared at the screen. $74,000 return. $112,000 required. The facility was busy. It was productive. It was real. And it was silently underwater by $38,000 every single year. Frank said it plainly. "Ryan, you didn't make a bad product decision. You made a bad capital decision. You invested before confirming the return would clear the cost." Ryan pushed back. "But we grew revenue by 70%. "Revenue isn't the test," Frank said. "The test is, does this asset return more than it cost us to fund it? If not, we'd have been better off putting that $800,000 somewhere else entirely." That sentence landed like a punch. Ryan had been celebrating growth, while quietly failing the only test that actually mattered to his investors. He spent the next 60 days restructuring the facility's operations, renegotiated supplier contracts, brought in a more efficient production manager, cut overhead he hadn't questioned before. 14 months later, the facility was generating $127,000 net contribution, finally clearing the bar. Ryan didn't have a business problem. He had a sequencing problem. He invested first, then checked if it made sense. That's backwards. The rule is simple, almost embarrassingly simple. Before you invest a dollar, confirm the asset can return at least as much as that dollar cost you to raise. Not revenue, not growth, not potential. Return versus cost. That's the only question that matters. Ryan printed that rule and taped it inside his office door. Every investment decision since, he answers that question first. Key lessons from this story. Revenue growth is not the same as value creation. You can grow and still destroy wealth. Every dollar of capital has a price. Ignore that price, and you're spending money you don't actually have. Invest only when the return clears the cost. That's not pessimism. That's the foundation of smart finance. Check the math before, not after. Restructuring after the fact costs more, in money, time, and credibility. Busy and profitable are not the same thing. A machine can run all day and still be a bad investment. People who think carefully about where money goes and why some decisions look smart but quietly aren't, tend to enjoy this channel. If that's the way you think, you'll probably want to stick around.